Okay, so in this video, my goal is to show conceptually and also practically how to think about this problem of capital allocation to risky assets. I'm going to start by showing the solution graphically with a capital allocation line and an investor indifference curve. And then I'll show you how to implement an example in Excel. That's a typo there. How to implement an example in Excel. And we're going to use Solver just to kind of illustrate this kind of simple example. This is one of the important building blocks to the Markowitz portfolio model, which is kind of the foundation of a good investments class. Okay, so what does kind of the graph of this trade-off between risk and expected return look like? Well, if you've been following along, in an investments context, we think of the reward to the investor as the expected return an investor can receive. And we can think of the riskiness of an investment as the standard deviation of the returns, not because we think volatility is what's risky, but that as the standard deviation increases, so the downside return that you can expect to receive becomes kind of less and less. And so that's the notion, sort of the downside risk, the risk that you could lose your money, it goes up as the standard deviation goes up. Okay, so kind of with that in mind, we're thinking about this trade-off, and we're going to think about this trade-off in the context of two assets. One asset is a risky asset. We're going to call it P. It's got an expected return. It's kind of illustrated here, and a standard deviation that's positive sort of indicates that there's a positive amount of risk. There's a chance that you could lose money and actually earn substantially less than the expected return. We're trading this asset off with a risk-free asset that earns a positive but smaller expected return. And with some sort of simple rules of linear combinations, what we can do is we can argue for there being a capital allocation line that connects these 2 points via a straight line in risk-reward space. The capital allocation line is going to tell us about portfolios. Here, I'm going to grab a brush that has some depth to it. And I'll show, so imagine that we're kind of on that point of the capital allocation line. What is that thing going to tell us? Well, it's going to tell us what expected return is feasible for that point. That's the expected return that you can get from that portfolio of the risky and risk-free asset. And this is the standard deviation that you can expect to receive from that. We're going to label this point, it's going to be labeled as point C for composite. It's a composite portfolio of the risky asset and the risk-free asset. We're also going to label the sort of amount. Here, I'll go and sort of label this. I'm going to call this sigma C. That's the standard deviation of the composite portfolio. This is going to be the expected return of C, which is the expected return of the composite portfolio. And the investor is being able to choose points sort of like C that are along this capital allocation line. How does that investor choose this? Well, the only thing that the investor can do is choose a fraction of wealth to put into the risky portfolio versus the risk-free portfolio. And the way to think about this capital allocation line is that if you want to have all of your money in the risk-free portfolio, you put 0% in the risky. So that fraction of money that you put in is 0%, kind of highlights that point at the risk-free point. 100% would highlight this point at the risky point. And actually greater than 100% would represent levered long portfolios that you could construct, sort of if you look back at the buying on margin video. A point like C looks like it's about 50% the way between risk-free and risky. That would represent a fraction of your wealth equal to, say, 50% of that. This capital allocation line has a convenient formula. You can already see that its intercept is the risk-free rate. And so you can say, well, what do we think about the formula? Well, the formula tells us how do we relate the expected return of the composite portfolio, to, type that again, the expected return of the composite portfolio is just a function of, well, what's the risk-free rate of return plus what's the slope of this of this. I'm going to put kind of the slope in parentheses. And then that'll be times, well, what's the x variable? That's going to be the standard deviation of the composite portfolio. We're going to relate sort of these two, these things. Oh, dang it. That is the problem with doing these things in Paint. Expected return of the composite portfolio equals the risk-free asset plus, well, whatever the slope is, times the standard deviation of this composite portfolio. Well, what's the slope? Well, the slope is rise over run. The rise is the expected return on the risky portfolio minus the risk-free. And the run is the standard deviation of the risky portfolio minus 0. And so that kind of gives you the slope of this. So standard deviation of the composite portfolio, P, minus 0, but you don't need to subtract 0 because that doesn't change what the standard deviation of that composite portfolio is. Now the thing about this is that here I'm going to sort of reformat some things. If something is a parameter of the problem, it is and is given to the investor, and the investor cannot change it with the investor's choices, I'm going to color code it in black. So you can see the investor can't change the riskiness of portfolio P. The investor can't change what the risk-free asset is or what the expected return on the risky asset is. Sort of all of these features here are just numbers from the investor's perspective. But what the investor can do is the investor can make choices that influence the standard deviation of C, in particular choosing points along this capital allocation line, and also sort of not unrelated choices that give us the expected return on this composite portfolio. And the investor's trying to pick the best composite portfolio, and that's the investor's goal. And so if we do this, well, that's our equation for the capital allocation line, and we're really just tracing out a relationship between the expected return on this portfolio asset and the riskiness of this portfolio asset. Now, something that's going to be convenient to sort of help us sort of think about this is that the standard deviation of the composite portfolio is just going to be the fraction of wealth that this individual puts in to the portfolio and to the risky asset times the risky asset. You might ask yourself, well, why would that be? Well, it turns out that if you want to think about, well, what are the returns for asset for this risky portfolio? It's going to be sort of the fraction of wealth that we put into risk-free times the risk-free asset plus the fraction of wealth we put into risky times the risky assets returns. And this linear combination if we think about kind of what's a random variable in this, the sort of RP is a random variable. And this sort of 1 minus y times the risk-free, that's just a constant. It has no influence over the standard deviation. So it's sort of useful to sort of point out that the standard deviation of C is really just this is how we can kind of make this choice of what standard deviation do we have in our portfolio, right? And so kind of these sort of two pieces are going to be critical for sort of thinking about what the solution to this problem will look like. Okay. Now, if you kind of think back to kind of what your what your sort of microeconomics course would teach you about an investor who has sort of risk-averse preferences, you can what you realize is that there's or at least the standard way to sort of articulate what a risk-averse investor's preferences are in kind of a finance context is to say, well, here, what is the expected return time minus 0.5 times A, which is our risk aversion parameter, times the portfolio variance. If we have an investor who has utility given by this, what is fairly straightforward to show is that you can draw indifference curves, and your indifference curves are going to give you a sense of, well, what's kind of the, here I'm going to sort of draw this, it's not sort of bright enough. I'm trying to draw, here we go, I'll draw this as a circle. I'm going to draw right here as a, that's sort of the ideal point for the investor. The investor would like to have zero risk and lots of return. In practice, the only thing that's feasible are the portfolios along the capital allocation line. But sort of this utility function embodies this sort of ideal. The ideal would be to have higher return, but to have lower standard deviation in the portfolios. Now, sort of important sort of building block of the way that investors evaluate portfolios is if this investor wants to relate portfolio C to some other portfolio, that investor can, what we can do to sort of think about this investor's preferences is compute the utility that this investor faces versus the utility of other possible portfolios that the investor might be considering. So we could discuss some of this in class. So part of this is review. I can refer some of the rest of you to sort of another video where I go into more detail about the types of trade-offs between sort of a good and a bad. But what you can do is you can kind of imagine, given this, that your investor, I'm going to make that a little bit bolder, faces a trade-off that looks at a bit something like this. And this is what's known as an investor's indifference curve. That's the investor's indifference curve that goes through point C, and I've chosen point C so that it's a very particular point in this investor's choice set. In particular, this investor is going to want to choose C as the optimal point. The way we see that is that this indifference curve, sort of short primer on indifference curves, it tells you sort of three things about, or tells you everything you need to know about the point it goes through and how you relate it to sort of other possible portfolios. Portfolios that are closer to the investor ideal, that are kind of on the inside of this indifference curve, are preferred. to point C. Portfolios that are along the same indifference curve, those give the investor the same level of utility, and so that investor is going to be indifferent between points that are along that, and points that are sort of on the other side, and the sort of below this indifference curve, farther away from the investor's ideal, are going to be sort of less preferred. And so from that kind of standpoint, way you can think about this is, well, here, I'm going to try to do this so we can shade in a whole region. So what I'm going to do, I'm going to put like a ray from that sun. And I'm just going to put a ray up that way. It's not an extension of the indifference curve, but the goal is to just kind of shade in a region. What I want to sort of illustrate is that there's this kind of area here that contains portfolios that are all better than C. Those are above the indifference curve that that passes through C. So this investor would prefer those portfolios. Now, what do you notice about the intersection between sort of that gray set of portfolios and the set of portfolios along the capital allocation line? Well, there's only one point in that intersection. Namely, point C is kind of right on the boundary, and there are no points along that capital allocation line, that sort of magenta line, that are in the set of portfolios that are preferred for that investor to point to portfolio C. So it turns out that when you have an indifference curve that is tangent to your capital allocation line, that for this reason, that like there are no feasible portfolios that are better for the investor. For that reason, we say that point C is the best possible portfolio that the investor can choose. Now, what do you notice about point C? Well, point C occurs where the slope of the indifference curve equals the slope of the capital allocation line. And if you kind of go through some math with sort of this kind of functional form of the utility function, what you'll realize is that the slope of the indifference curve has sort of a nice, well, that's a nice gray way to put it. The slope of the indifference curve is the risk aversion parameter times the standard deviation of the portfolio. That's just something that pops out of our marginal rate of substitution formula. Slope of the capital allocation line was just given up here. It's the expected return on the portfolio minus the risk-free rate, that's the risk premium, divided by the standard deviation of the portfolio. Now, recolor coding to kind of match what we had up here in our equation for the capital allocation line, there's only one thing that this investor can do anything about. That is the standard deviation of the portfolio. So in this equation that equates slopes, this is the slope of the indifference curve, this is the slope of capital allocation line. There's only one thing that this investor can control, and that is the standard deviation of the composite portfolio. How can the investor control that standard deviation of the composite portfolio? Well, that goes back to that kind of linear combination formula here. That standard deviation of the composite portfolio is just a function of the fraction of wealth the investor puts into the risky asset, and then times, oh, and that's a bit unfortunate. That was a typo. It's going to be times sigma of the risky portfolio, P. So apologies for the typo. Hopefully you saw that when it happened and said, oop, 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 you're making a mistake. Here, we fixed the mistake. this sort of linear combination math gives us that the standard deviation of the composite portfolio is the sort of the risky share times the standard deviation of the risky asset. This formula we can just kind of plug in here, and then sort of instead we can't really do anything about the standard deviation of the risky asset. But what we can influence, what this investor can influence, is sort of the Y, the fraction of wealth in risky assets. If you do that and then just solve for Y, what you end up getting is the formula that we get for so the optimal risky share. It is the risk premium divided by the risk aversion, which you just sort of divide through by A on sort of left-hand side, times the standard deviation of the portfolio squared. So the volatility of the, or not the portfolio, of the risky asset. So this formula ends up embodying exactly what this sort of optimal capital allocation to risky assets is. It then gives us a way to gives us a way to figure out, well, what is that asset, or what does point C look like on this graph? So how do you find point C? Well, you can plug in kind of into this formula. That'll give you the fraction of wealth that you put into risky assets. And then all you do is you can plug in kind of what Y star is to figure out what the standard deviation of the sort of risky asset is. So you can sort of multiply standard deviation of the portfolio times Y star, and that gives you standard deviation, this kind of sigma part here. Right? So sigma C would just be whatever Y star you solve for times sigma P, the standard deviation of the risky asset. And then you can just plug into the capital allocation line to figure out, well, what's the expected return of this composite asset. And it gives you an outline of what this optimal solution looks like. So that's kind of doing the investor capital allocation to risky asset problem from an analytical perspective. Now, from an Excel perspective, it's we can kind of do a little bit kind of more brute force kind of solution here. So let's kind of set this up so that we can kind of this is going to show you kind of how to do this with a calculator within Excel. And so first of all, I just want to show that the expected return of the composite asset. Well, we'll see, how do we think about this? Well, that's just going to be the risk-free rate times, well, how much money do we have in the risky asset? It's going to be 1 minus the share of wealth in risky assets. And what we'll do is we'll add the expected return of the portfolio, or of the risky asset, times, well, what share of wealth do we have in the risky asset? That's just going to be A5. Now, I want to show you a little trick. It'd be nice if I were to copy this down. Here, I'll kind of show you first that if I just were to copy that down, what happens is that sort of every cell's position gets dragged down. The way you can that's nice from the standpoint of like sort of referencing the sort of this changed share of the risky asset. So I don't want to change sort of these red references, but kind of this purple reference and the blue reference, I'd like for those to kind of stay put. What's Excel speak for stay put? It's kind of putting a $ in front of the thing that you want to stay put. I want the row to stay put as I drag this down to sort of bottom or lower and lower rows. And so $2, it still references that point, but it tells Excel that when you copy things, we want the references to stay put for those bits, but not for the y bit. We can do the same thing for standard deviation of the composite portfolio. We saw this was an important aspect. We go y times the standard deviation of the risky asset. And so you can see there's the risk-free asset just kind of recovered. Expected return is 2%. The standard deviation is 0. Here, similar thing here. Now we want this so reference to sigma p to stay put as we consider different levels of this that we're interested in. And what you can see is, like, now what we have is actually, if we were interested in sort of plotting this, we go to recommended charts, and it gives us a little bit of a weird looking graph because, like, standard deviation and return are kind of on opposite sides, but you can see that this is relating the expected return and the standard deviation in the way that we just kind of drew graphically on the plot. Now, we could kind of brute force this and say, well, what is the utility function using kind of the standard investor mean variance utility? And you can see here in this example, I've said that the investor's risk aversion is going to be 4. Well, how do we calculate this? Well, we do expected return minus 1/2 times the risk aversion times the standard deviation squared, and that gives us the investor's utility. Remember, this utility function gives us the certainty equivalent return, and so for a certain bundle, like for this risk-free asset that we're evaluating here, the certainty equivalent return should be exactly the same as what we had there. Now, when I drag this down, I want the expected return to come along with me. I want the standard deviation to come along with me, but I'd like to keep that sort of reference to risk aversion in that same cell that I had above. And so I can do this and say, well, okay, how does this look? I can just then drag this down. And so what you'll see is that, like, this expected, that for different levels of wealth in the risky asset, utility is going to change. And we can kind of zero in on what we think looks like sort of the best of these. It appears that around 70% of wealth in risky assets is what's going to be best. For using the analytical solution that we had before, though, what was y star? Well, y star was just the risk premium. So you get a risk premium of 6% divided by the risk aversion times the variance. That was from kind of what we did over there in MS Paint. A little clunky algebra, but hopefully the sort of the time it took me to sort of mess around with Paint, I could kind of explain this in a way that made sense. This is the analytical solution. You see that actually the analytical solution gives us an answer of 0.67. You know, if we're interested, not file, home, let's give it kind of more, looks like about 2/3. It looks like a repeating 6. So that kind of gives you, well, you know, 0.7 is pretty close to that. I guess we could have kind of drawn a grid that was sort of finer and gotten closer and closer to what that analytical solution is, and finding the sort of the point that gives the investor sort of the greatest utility. Well, let's actually see if we can do a little bit better with Excel. So here, imagine we started with that kind of 0.7 possibility, or maybe even just start at 0. Let's now construct this, just a representative example of kind of what we had done right there. So here, risk-free times 1 minus the weight on risky assets plus risky times the weight on risky assets. That gives me my expected return. And you can see here, just the risky share times the standard deviation of the risky asset. And that gives me the standard deviation of that asset. And then I can just compute, well, what's the investor's utility as a function of this? 0.5 times the risk aversion times the standard deviation squared. And there's the utility for my investor. Now, Excel has this really sort of nice feature to it, which is that if you kind of go over here to data, and if you have the solver add-in enabled, there's this thing called Excel Solver. What you can do is you can tell it, I'd like to maximize the value of this cell, J5. J5 is utility. I'd like Excel to go and try a bunch of values of Y, that's G5, such that utility is as high as possible. And that's what it's going to do. Is it's just going to kind of go try a bunch of different values, and as it changes this cell, it's going to change this utility, and it's therefore going to, you can think about this as sort of evaluating a function. And so all you do once you have this kind of set up, we set up this kind of calculator so that if I input sort of different levels of the share on risky assets, it's going to give me different portfolios, which then give me sort of the utility. And then just ask Excel, can you maximize utility for me? Maximize utility. Lo and behold, the solver found the analytical solution. The analytical solution that we had kind of perfectly matches what the Excel solver found when it was trying to then just sort of maximize utility by trying different values. Now, the Excel solver is pretty neat in that it sort of allows us to sort of not have to work with the calculus. However, there's kind of some nice intuition about the form of the solution. Namely, the share of wealth that we put into the risky asset is really it's got some sort of intuitive features to it. So higher is the risk premium, the more investors going to want to put in to this asset. You can see that in the numerator of this functional form. Higher is the risk aversion, that A parameter. The smaller is going to be this fraction, and so less that the investor's going to want to put into risky assets. And moreover, so the higher is the volatility, standard deviation, variance of the risky asset, so the less a risk-averse investor is going to want to put into this. This sort of has this sort of nice qualitative features that we wouldn't be able to see necessarily if we just did everything numerically. Hopefully, though, kind of showing you the sort of interplay between kind of the numeric and also kind of the sort of the analytic gives you a greater appreciation for sort of how to think about this problem of capital allocation to risky assets. So, thanks.